Welcome to The Explainer. I am absolutely thrilled to have you here today. Look, if you've ever felt completely overwhelmed by the stock market, you are in the exact right place. Today, we're breaking down a battle-tested blueprint straight from Mark Tilbury, a millionaire investor. We're going to distill a lifetime of financial knowledge into a super clear step-by-step masterclass, pulling the absolute best, most essential strategies directly from our source material.
Right off the bat, I want to anchor our entire explainer around one giant number, 40. You see, our source material today is entirely grounded in Mark Tilbury's 4 decades of successful stock market experience. We aren't looking at some theoretical textbook ideas here, and we're definitely not chasing fleeting internet trends. We are looking at 40 years of real-world wealth building. Having that kind of long-term perspective, that is your ultimate unfair advantage.
Okay, let's dive into this, because this specific quote beautifully frames our entire journey today. We are essentially looking over the shoulder of a seasoned mentor who is stripping away all of their current wealth and asking, how do you build it all back from absolute zero, armed with literally nothing but a smartphone and a small paycheck? It's the ultimate reset, and it makes these lessons just perfectly tailored for beginners who want to skip those super costly traps.
So here's our roadmap for today. 1. 40 years of wisdom. 2. Setting up your account. 3. The 3-fund portfolio. 4. Buying your first stock. 5. When to actually sell. And 6. The power of consistency.
Starting with step 1, 40 years of wisdom and the platform checklist. You know, when you're deciding where to actually park your money, analysis paralysis is so real. There are thousands of apps out there, and frankly, the fear of picking a scam just stops people dead in their tracks. But leaning on Mark Tilbury's 40 years of experience, this checklist is non-negotiable. First up, FCS protection. This just means if the platform itself goes bust, your money is protected up to £120,000. Safety first, always. Then you want low fees, access to tax-advantaged accounts like an ISA, and a really simple interface. Oh, and a quick heads up, to pass the standard regulations on secure platforms like, say, Trading 212, you're going to need your photo ID, your national insurance number, proof of address, and be ready to snap a quick verification selfie. Moving right along to section 2, setting up your account and picking the right vehicle. Now, what's really interesting about this slide is just how much choosing the wrong account right out of the gate can hurt you. It's a mistake that could literally cost you thousands in unnecessary taxes down the line. Just look at the massive contrast in risk and tax penalties here. With a general invest account, you're handing over 10 to 20% of your hard-earned profits straight to capital gains tax. And that CFD account? Tilbury emphatically warns beginners to avoid this high-maintenance day trading vehicle altogether. I mean, 80 to 90% of traders actually lose money there. So the absolute standout winner here is clearly the Stocks and Shares ISA. Okay, so the crucial thing is making sure we understand exactly how this ISA works, because there is a massive beginner myth we need to bust right now. A lot of people hear 20K limit and assume they are only allowed to make $20,000. That is totally false. That 20K limit is only on your initial contribution per year, meaning your portfolio could compound and grow to over $1 million over the decades, and you'd pay absolutely zero tax on those massive profits. It's incredible.
Section 3, the 3-fund portfolio, keeping it boring.
All right, now that our tax-free account is all set up, what do we actually put inside the thing? Well, this strategy is heavily inspired by John Bogle, the founder of Vanguard, and that famous investing community known as the Bogleheads. Their whole philosophy: keep it boring, survive recessions, and require absolutely zero daily stress. To get this, we just need to quickly define a fund. Think of a fund like a giant shopping basket. Instead of betting every penny you have on one single apple, you just buy the whole basket. For example, if you buy an index fund like the S&P 500, it automatically takes your money and spreads it across 500 of America's top companies all at once. We're talking giants like Apple, Amazon, and Coca-Cola. Boom, instant diversification.
And when you're picking these funds, Tilbury highlights a super vital term you need to look out for: accumulation. See, when you buy a slice of these big companies, they often pay you a little thank you bonus, which is called a dividend. An accumulation fund takes those dividends and just automatically reinvests them to buy you even more of the stock. Honestly, it is the ultimate set and forget hack for this entire 40-year blueprint.
So how do we actually mix our funds together? Well, it totally depends on your age and how much risk you can stomach. For an older investor, notice that huge 40% slice dedicated to bonds. A bond fund is essentially just lending your money to a government, and they promise to pay you back with a little extra on top. It provides this incredible stability to protect the wealth you've already built, kind of acting like a shock absorber for the crazy ups and downs of the stock market.
But look at how the strategy shifts for a younger, moderate-risk investor. Those bonds shrink all the way down to just 10%, while U.S. and international stocks take over. Why? Because younger investors have decades on their side. If there's a huge historical market crash, they literally have the time to just wait it out and let the market recover. For a young person, it's actually riskier to not take those calculated growth risks. Next up, Section 4, Buying Your First Stock, Execution. This right here is the exact moment where theory meets reality. And hey, the fear of hitting that buy button for the first time, it's completely valid. When you go to buy, you're going to get hit with a bunch of intimidating jargon, limit orders, stop limits. You can just ignore all of that. Tilbury's 40 years in the game make it crystal clear. A market order is all a long-term investor ever needs. It's just a super straightforward command telling the app, hey, buy this instantly at today's price. Because over a 20 or 30-year time frame, tiny price differences on the specific day you bought simply aren't going to matter. Let's actually walk through the steps using an individual stock like Tesla as a fun example. Step 1, search Tesla. Step 2, make sure market order is selected. Step 3, choose value. And this brilliantly illustrates the absolute magic of fractional investing. A full share of Tesla in our source example was trading at $422. But by selecting value, you can type in just £100. You literally become a fractional owner of that massive company with whatever you can afford. Then, step 4, just hit send. Done.
Which brings us to Section 5, when to actually sell, the exit strategy. You know, everyone fixates on what to buy, but you absolutely need strict rules to overcome the emotional urge to sell out of fear or just stubbornness. Knowing when to sell is what actually secures your wealth. The first rule comes down to understanding the difference between fundamental and momentum value. Fundamental value is the real deal. It's the assets, the actual revenue, the true business. Momentum value? That's a mirage. It's fragile pricing driven completely by online hype and emotions. Tilbury points out that if a stock is running purely on momentum, it is going to crash. Take Lemonade Inc., for example, a stock that got aggressively pumped by influencers, only to totally collapse the second reality set in. When the momentum is dying, you sell.
So here is your master checklist for selling. Reason 1, as we just covered, momentum is fading. Reason 2, you actually need the capital for a much better, bigger, real-world opportunity. Maybe buying a great piece of real estate or starting a business. And reason 3, the broader market has fundamentally shifted against the company. Look at Warren Buffett. He notably sold off his airline stocks during the massive COVID shift, and he dumped Tesco after an accounting scandal. Mark Tilbury himself even dumped all his newspaper stocks the exact moment smartphones took over. You just cannot hold on to a stock out of pure loyalty.
And finally, Section 6, the power of consistency, time over hype.
I really want you to etch this phrase into your brain. Time in the market beats timing the market. You can pick the perfect app, the absolute best tax account, and the right funds, but without the mindset to actually see it through, all those mechanics won't save you. Compound interest does not care if you're confident. It doesn't care about your emotions or how motivated you feel today. It only responds to one thing: mechanical, boring consistency. The people who actually win in the stock market over 40 years aren't the fastest, flashiest traders. They're the ones who buy, reinvest their dividends, and just stay in their seats during the roller coaster.
So this brings us to the ultimate question you have to ask yourself after reviewing our explainer today. Will you chase the hype, or will you let time do the work? You now have the exact step-by-step blueprint from a millionaire mentor who spent 40 years learning these lessons the hard way. You know how to avoid those nasty day trading traps. You know how to leverage tax-free accounts. And you know how to build a super boring but brilliant 3-fund portfolio. The only thing left is for you to decide what kind of investor you're going to be. Thank you so much for joining me on this explainer, and I really hope this empowers you to kickstart your own disciplined investing journey.